I'm Susan Grassley. I am an attorney and I joined GBS back in 2011. Does that sound like forever ago? And I was brought on specifically to help our clients navigate the Affordable Care Act. So I have been here educating our clients on that since that time. And I'm excited to do a kind of a recycle of what we used to talk about. So, who was out of curiosity around when this was ramping up, the Affordable Care Act? Just a few of you. And who here is the Affordable Care Act is like brand new in terms of their understanding and engagement in it? Okay, great. So we've got a mixture of all of it. Good. Okay. So today we are talking about foundations. And the reason we call it foundations is I love context. And I think context is really important to have when you are understanding a law. This masterclass, as you know, is 4 weeks in a row. And today is our context seminar. This is going to give you your foundation and understanding of the Affordable Care Act as a whole, big overview, which I think is really important to understand in order to understand the parts that you have to kind of get involved with on a daily basis. The next one will be a deeper dive into one of the provisions, which is the employer mandate. And we'll talk about the steps that we created to help you navigate that. And then the third one takes a deeper dive into one of those steps, which is measurement methods. And that is a really important part of identifying who is eligible and when you have those questions within the context of the Affordable Care Act. So really, really important. And then the fourth one is mastering, not only understanding the rules in general, but understanding how to apply those rules to your specific measurement method policy, which you will have completed through the 4 steps when you work through those 4 steps. Okay, so that's our big overview today. Today's agenda is we're going to do a super high level background about how the law got created. And then we're going to talk about the exchange marketplace, the employer mandate, and the individual mandate, which are all kind of 3 big provisions that kind of work together and dovetail together and interact with each other. And those are the parts of the ACA that you hear about the most. We're also going to talk about the tools that we have with GBS that help you navigate that just briefly. And then market reforms. Market reforms are a big part of the ACA. They don't get a lot of attention, but they are really important and important for you to understand. So that will be our schedule for today. So let's jump right into our background. This law, the Affordable Care Act, actually came from 2 separate federal laws. One was called the Patient Protection and Affordable Care Act, and the other, which was passed just a week later, is called the Healthcare and Education Reconciliation Act. That is a mouthful, as most laws are. And so collectively, they are referred to as one. It used to be, when this first ramped up, people mostly called it PPACA, or Patient Protection and Affordable Care Act. It's also referred to as Healthcare Reform, or HCR. Obamacare, some people use that phrase, and the Affordable Care Act, or ACA. And that's the phrase that I will be using, is the ACA. There was an effective date. People think, oh, this law passed, there's one effective date. There are so many provisions in the Affordable Care Act that there were several different effective dates. If you were around when this all was getting ramped up, it was kind of a whirlwind. It was like drinking from a fire hose, trying to figure out what was effective and when and what you needed to do. But most of them were effective between 2012 and 2014. Some didn't ramp up until 2015, the employer mandate and reporting, that didn't come until then. And some actually still on the books, is still part of the law, but we still don't have effective dates for those. Those have kind of been put on hold. So when a law is passed at the federal level, there are U.S. agencies that are assigned regulatory authority to that particular law, meaning they do a couple of things. One of them is to create regulations. Regulations is kind of a big kind of umbrella term without getting into specifics, just high level. It comes in different forms, but it's information that they create that helps us understand better how to comply with the law. When a law is passed, Congress can't possibly anticipate or include in all the details you need to know in order to comply with it. And so that's what regulators do, is they interpret that, clarify it, and that comes in forms of final rules, safe harbors forms, FAQs, templates, all kinds of things. That's sort of the simple way of explaining it. For this law, these three departments, HHS, DOL, and IRS, also have authority to investigate compliance. So they're enforcing these laws as well, not just creating the explanation to help you understand better how to comply with it, and also to assess penalties or a tax if that's appropriate. And that's why the IRS or the Treasury is involved too, because they're the entity that does that. Just really quick background. We're not going to talk politics, but I think it's interesting to have this information because a lot of people will still ask me, oh, the ACA is going away, right? Or I don't need to worry about this because it's going to go away. This was passed during Obama's administration, and the Trump administration didn't repeal or replace it, but tried to, but chipped away at the ACA using different other methods other than a big repeal. And then the Biden administration does support the ACA and has taken steps to consistent with that. And Congress, just so you are aware, generally, of course, have divisions on what this law should be, but there are a lot of provisions that they agree on. And two examples of those provisions that we'll talk about toward the end that are part of the market reforms include coverage to age 26 and no pre-existing exclusions that are allowed. So those are some of our examples. The US Supreme Court has also gotten involved in this because some questions as to whether something's constitutional or appropriate or not has come that far up to the US Supreme Court, and they've weighed in at least 5 times. But the bottom line is, given this context, that this, the ACA, is for the foreseeable future going to remain intact and enforced, even though some changes and adjustments have been made. Okay, so because of that, it's important to understand what the rules are and how you need to comply. And so I'm glad you're here so you understand. So here's I love visuals. I'm such a visual learner. Here is my big picture Affordable Care Act. I like to divide it into 4 sections. We've got the exchange and marketplace and the subsidies you can possibly qualify for in there. We've got the employer mandate, we've got the individual mandate, and then we have the market reforms. Now, the exchange, the employer mandate, and the individual mandate are the versions or the provisions, that dovetail together and interact with each other. And they're the ones that you hear the most about. They're like, for lack of a better word, popular is not the right word, but it's the one you hear, the versions you hear the most about. But there are several other really important provisions as well that are part of the ACA that I want you to be able to be aware of and know about, and that are important to know about. So given those 4 parts, we're going to jump in and do some more detail on the biggest 3, and then we're also going to, time allowing, talk about just high level a lot of those other market reforms. So let's jump into the exchange and marketplace first. So here's the basics on exchange and marketplace. In the ACA, states were required to do some things. One of those things is to create an online health insurance marketplace. And this is a place for individuals and families to get insurance. So health insurance. Originally, it was called the ACA Exchange. Now, officially, it's called the Marketplace. One of the same, but the intent, or one of the intents, is to provide a single location where you can shop options side by side, and have an easier ability to understand what you're buying and making comparisons. You can also do that with the help of a broker or an agent or an assister is what they call them, or you can just get online and do it yourself. So that's the general idea of the marketplace, but states had the option. They were given the option to, how do you want to run your state exchange? One of those options is you can run it yourself, all on your own, state-based fully. Or you can have a state-based marketplace with a federal platform. That means you're running your state exchange, but you're using the federal government's platform for the exchange. Or you can have a federally facilitated marketplace, which is you're not running it, it's your state, but you're not running it yourself at all, and you're not creating the platform. The federal government is running it for your state. So here is a map, current map of what states have decided to do. And this has kind of evolved over time. But you can see that in the light blue, those are states where the federal government runs it completely. And that means that you go on their website. The dark blue is a state-based. They run it completely on their own, create their own platform as well. And then we have the hybrid version, which is you're using, the state is running it, but they use the platform of the federal government. So what types of plans are offered on the exchange? There are specific rules about this. It had to fit within 4 what they called metal options. The cheapest could not be any less than this bronze level, and the most expensive goes up to platinum. And what that means is all plans had to meet a specific minimum value level, meaning the amount that an individual or family had to pay could not exceed 40%. So what that means is that bronze is the cheapest, but the participant is paying not the monthly premium, but the participant is paying everything else, not more than 40% of the costs. And so on a bronze plan, you might be paying less monthly, but you're going to be paying more out of pocket for services. Versus the platinum plan, you may be paying more premium monthly, but once you have some sort of services, 90% of that is going to be paid by the plan and not by you. So these plans had to fall within one of these 4 options and can't exceed the lower version of that. Okay, let's talk about the subsidies. So we have these 4 types of plans, and the subsidies are helps or a financial help paying for these costs. So individuals and families with lower household income who purchase in the exchange may qualify for it depending on their household income, and it's a sliding scale based on percentage of household income. And there are 2 different kinds of subsidies. One subsidy is called the premium tax credit, or the PTC, and that's the subsidy that helps the family or individual pay the monthly premium. And then there's another one called the cost sharing subsidies, and that's the one that helps the family pay for the other out-of-pocket costs, not the monthly premium, but other things like the copay and so on. The household incomes that qualify for ACA subsidies is interesting. If you make too little, you don't qualify. And that's why that's kind of lighted out there. If you make under 100%, your household, if your household brings in less than 100% of the federal poverty level, then you're not going to be able to get a subsidy in the exchange. You should be going, if you want some help, to get apply for and get Medicaid. But for households that are between 100 and 400% of the federal poverty level, FPL, you would qualify for a subsidy. And again, it depends on where you are on that sliding scale. And if it's between 1 and 250, you'll, sorry, I need to distinguish. There's 2 different kinds. If your income is between 100 and 250, you're going to get the subsidy that helps you with your out-of-pocket costs besides the monthly premium, and you're going to qualify for the premium tax credit, which helps you with your monthly premium. If you're between 100 and 400%, so those between 250 and 400% will also, or could also, qualify for the PTC or the monthly help. So why are we talking about this? This is individual coverage, right? But this impacts employers who are large, and it could impact employers who are small too when it comes to participation. But the subsidies can trigger if you have an employee who's full-time and you're a large employer. If they, instead of opting into your coverage, or if you don't offer coverage and they go to the exchange and what you offered, if you did offer, was not affordable or didn't meet minimum value, then they could qualify for that subsidy, and that will trigger the penalty to you as the employer. And we're going to talk about what that penalty is and who's a large employer in a minute, but I just wanted to give you a spoiler there if you're not aware of that. So before we move on from the exchange, I want to explain what's happened recently with the subsidies with the PTC, the one that helps you pay for your monthly premium. There were two laws that have been passed since 2021 that has increased the category or the percentage of federal poverty level that you can have household income in and still qualify for. In other words, as the law was originally written, you qualify for the subsidy if you're between 1 and 400% of the federal poverty level or your household income. The American Rescue Act expanded that and said, even if you are beyond 400%, some of you may still qualify. And the way you would qualify is whether the cost of the premium would exceed 8.5% of your household income. If it does, you, even though you're beyond 400%, you will still qualify for a subsidy. And that expansion originally with the American Rescue Plan Act, that was the act. There were lots of things that were passed during COVID to help families. And that was one of them, is to expand that so that more families could get on coverage, especially during all the COVID mess. And then the Inflation Reduction Act, which was passed in August of 2022, expanded that beyond 2022 to 2025. So we have an expansion that is effective through 2025. And that's important for you to be aware of. But let me just explain how this works in case you're in, because I think it's important to understand from an employer's perspective. This chart shows the income and how it's broken down on your percentage of income. And the middle category shows what percentage of your income you will pay toward the monthly premium. So if you fit within 300 and 400% of the federal poverty level and into the middle category, Affordable Care Act, your subsidy, you're going to pay only 9.83% of your household income toward that subsidy. If it's beyond that, you won't have to pay that. If it's less than that, that's fine. But if it's more than that, then you won't have to pay it. The two recent acts that were passed changed those percentages, and the percent families need to pay toward the monthly premium. So if you're between 300 and 400% now up to 2025, you'll be paying between 6% and 8.5% of your household income, not the 9.83. Does that totally make sense or totally confusing? Okay. So, and then you can see there's a category, if it's over 400%, you still may be able to get a subsidy. Okay. The effect of the changes of this expansion on the premium tax credit on large employers is important, because if there's an expansion of more people who are going to qualify for the subsidy, it exposes large employers to more people who could trigger the penalty against large employers. And so it's more important to make sure that you, if you're a large employer, are careful and are doing what you can to make sure you're complying with the law and you don't get a penalty triggered. Yes, I saw a hand back there. That's a great question. She asks, what specifically are the household incomes that meet the federal poverty level? I should add that chart. I used to have that chart in here, and yes, it changes every year. They adjust it for inflation every single year. And you can get it online. If you Google it, you can see actual salaries. What families, if you are making this income, you're falling within this percentage of the federal poverty level. So maybe I should add that. Here's just one last thing before we move from the exchange I wanted you to be aware of. And I've seen this more, not as much recently as we used to see, but there is a letter that some employers receive, and it's a letter you're supposed to receive as an employer, that comes from the exchange via HHS, that says that you have an employee who has received a subsidy in the exchange, meaning they've gone to the exchange, they've purchased there, and they've qualified for a subsidy. And it's not a penalty letter. It's just a heads up. This is what's going on. And there's some options. You can respond to it or not. I haven't talked to anybody recently about receiving that, but those who have received it kind of freaked out because they thought it was a penalty letter. So if you get one of these and you have questions about it, contact us and I can help you walk through it. But it's actually quite a helpful letter because it helps you understand that you've got somebody. You're not wondering whether you have somebody going to the exchange. You know that they have, and you can make sure all your ducks are in a row. Okay. We've talked about the exchange now. Now we're going to talk about the employer mandate, one of the other three parts of the ACA that you hear about a lot. And then again, like I said, we'll talk about the market reforms. Here's the general rule on the employer mandate. Sometimes it's called the employer shared responsibility. I used to refer to it as that because that's technically the more accurate way of referring to it, but it's more of a mouthful than employer mandate. So I have changed and we're making it simple. So an applicable large employer, you hear the ALE, that's what we're talking about. And that just means a large employer to whom this law applies. So I sometimes just say a large employer, avoids ESR penalties. ESR stands for employer shared responsibility if it offers affordable minimum value coverage to at least 95% of their full-time employees and their dependents. That's the main law. And again, we talked about this before. You're not required as a large employer to offer coverage. But if you get triggered, you will, and because you didn't, you will get a penalty. But this is the only way that you're triggered. A full-time employee, one of your full-time employees purchases coverage in the exchange. Again, they have to be full-time, not part-time. That employee qualifies for and uses a premium tax credit. And you, as an employer, did not offer affordable minimum value health coverage. You may have offered coverage, for example, but it wasn't affordable or it didn't meet minimum value. And again, here's the important thing to understand. Even if an ALE or a large employer isn't compliant with the employer mandate, the federal government doesn't care at all in terms of penalties. You'll totally fly under the radar unless you have somebody go to the exchange. And if you do, then the federal government is going to assess an additional tax to have you help the federal government pay for these subsidies. So that's the whole point. If you don't have anybody go there, they're not going to have a subsidy. Okay, so let's talk about the penalties specifically. The penalties are divided into two sections. And you could get a penalty, you'll only get one penalty. So the penalty is found in the Internal Revenue Code in sections 4980H A and B. And I only give you those boring numbers because it helps to understand that we refer to these penalties in shorthand as the A penalty and the B penalty. So the A penalty would be assessed if you as a large employer fail to offer minimum essential coverage, and we'll talk about what minimum essential coverage means, to at least 95% of full-time employees and their dependents. It does not have to be affordable. It doesn't need to meet minimum value. If you fail to offer to at least 95% of them, this penalty will hit. Penalty B is you may have successfully offered coverage, minimum basic coverage, minimum essential coverage is what it's called, to 95% of your full-time employees, but what was offered was not either affordable based on the thresholds the government has set up, or it doesn't meet minimum value. So we're going to dive into a little bit on what all these words mean in these sentences. So the A penalty, what does applicable large employer mean? A company that employs 50 or more full-time employees plus full-time equivalents on average per month based on the prior full calendar year. So there's an actual calculation that you're going to make based on the full January through December of the prior year to determine your size. And you're not just counting people who are eligible. You're not just counting full-time employees. You're counting all of your employees, and full part-time employees collectively equal full-time employees based on a calculation. A full-time employee is not one who works 40 hours a week. It's one who works 30 hours a week on average, or on average 130 hours per month. And there's a way to calculate that, which we'll talk about. Minimum essential coverage is basic coverage. Basically, the definitions in the regulations is basically if you offer coverage, you're basically offering minimum essential coverage or MEC. And dependents, what does that mean? That is a question that's often asked. In terms of this law, it means just the employee's children up to age 26. It does not include spouses. Now, of course, a lot of employers do also offer spouses, and that's for a variety of really good reasons. But per this law, you're just needing to offer to dependents. Okay, the B penalty. What do some of the words mean in this definition? And the big keywords here are affordability and minimum value. A minimum value is what we talked about when we talked about the exchange. And that's a great, I think, that visual, if you recall a visual of the 4 metal plans. And we talked about if you pay a certain amount, the plan has to pay, or the employer has to pay a certain amount for it to meet minimum value. So that's what we're talking about. A minimum value plan must at least pay, you as an employer must at least pay 60% of the total cost of the plan, not including the premiums, total cost of the plan, so that the employee doesn't need to pay more than 40%. You can be more generous and richer, but that's the minimum. An affordable plan is a plan that where an employee is not required to pay toward the monthly premium more than 9.5% of his or her household income. And we'll talk about, as you can imagine, we need to talk about that a little bit more too. So here's more on affordability. A plan where the monthly premium cost for single coverage does not exceed more than 9.5% of household income. Now, first of all, that 9.5% is indexed every year for inflation. So that goes up and down, mostly up, but every once in a while it will go down, depending on what's going on with inflation. Household income is the thing I want to talk about here, because that's really tricky. You as an employer, how could you possibly know what your employee's household income is? You only know what your employee's income is, right? So that's tricky, and regulators understood that, so they created what's called a safe harbor. A safe harbor is something that if you follow the safe harbor, then you're safe, meaning that this definition of affordability is safe, and you don't have to guess whether your definition of affordability is going to fly. You can come up with your own affordability definition if you want, but you would have no idea whether this is going to pass according to the government. So the bottom line is it's always really safe to use the safe harbor. Huh, no pun intended. No, that wasn't even funny. I didn't even get a crack there. Such a dad joke, or a mom joke, I should say. So the tri-agencies, we sometimes call HHS, DOL, and IRS, or the Treasury tri-agencies. Sometimes we call them the departments. It's all the same, but we're all talking about them. But they came up with a safe harbor, and you get the option of 3 ways to define affordability. So it's really vital, just so you know, minimum value is pretty easy to figure out. That is not tricky. Most plans on the market now automatically at least meet the minimum value. So every once in a while, if you've got an employer who's really trying to do a skinny plan, it might not. So if you're on that threshold and you're trying to play that game, make sure that you are checking minimum value, and you should check it all the time anyway, but it's probably not going to be an issue. But the affordability is the big one. That's the big flashing light that you need to be careful of. We have a toolkit, and we'll talk about it more next time, that helps you figure out your affordability safe harbor. We've got a calculator. It's super. It takes you 2 seconds to figure out which one you want to use. 2 seconds. Okay. 1 minute. I shouldn't be dramatic. 1 minute to figure this out. And that's in our step 3. But the point I want to make here is this is something that you don't do once and then you're done. Every single plan year, when you're making your decisions about contributions, you're sitting down and thinking, okay, how much are we as an employer going to pay toward this monthly premium? And how much are we going to ask our employers to pay toward this monthly premium? You need at least one plan that meets affordability. They don't all have to, just one. And you want to look at that before you make all your final decisions, before you do your open enrollment, before you do your booklets. If you don't, and then you realize later that you aren't affordable, then you're in a mess and you have to create all this backtracking. So every year prior to your plan year, make sure you're entering into that discussion and saying, hey, I need to do step 3. I need to do my affordability check. Okay. So penalties. This always comes up. Said, well, Susan, what happens if I don't do anything? What is my penalty? And it's a valid question. Like, I need to weigh the pros and cons of this. What is the cost? So I've created a chart, and one of these days I'm going to have to drop off 2015. This is the first year that it was actually effective. But this gives you the actual math on the penalty calculation. So the A penalty is the one that's going to be most expensive in most cases. And the B penalty is usually a lot less, although there are exceptions depending on the size of the employer. The A penalty is calculated. I'm showing you calculations based on assuming that you were assessed a penalty every month of the year. It just makes it easier to explain to you. But know that there is a monthly, you could be assessed a few months of the year and not all the months. But for purposes of learning, in 2024, for example, if you go down to that line under the first column, the way you calculate a penalty if you get dinged with this is it's $2,970 multiplied by all your full-time employees, including those employees who received coverage. So not just the ones who didn't, all of them. So that's why that one ends up being pretty expensive. And then the B penalty, if you go across to 2024, is 4,460 multiplied only by the number of employees who went to the exchange and qualified for a subsidy. So the B penalty, you may not be affordable and you may have 3 employees who went to the exchange and got a subsidy. So your penalty amount would not be under A penalty because you offered to all your full-time employees, but it wasn't affordable and it wasn't affordable for like 100 of them, let's say, but only 3 went to the exchange. You're going to be penalized or taxed only on those 3. So it'd be 4,460 times 3. Okay. So here I have the penalty monthly breakdown for 2024, just so you can see that you get those amounts on 2024 that I had. You divide that by 12 to get the monthly. And that is the amount that would be multiplied. That's your multiplier, either under the A penalty or the B penalty. The next question that I always get or that comes up in people's minds is, okay, Susan, how often I hear about all these compliance things I need to do, but I know that I've been out of compliance on A, B, or C, whatever the law is, and I've never been caught. What are the chances that I will get caught? The answer to this is extremely high, like 100%, because everything has been, what's the word? What is the word? Everything's electronic. We don't need individual. I have lost my words, but we don't need individual IRS people to look into your file and determine whether you are or not and do an investigation. It's all done electronically, and it's all done electronically through the forms, the 1094 and 1095 forms. And so that's one of the reasons we have these forms is we're reporting to the IRS and to the departments what we have done as an employer. And the kind of forms that you have to create are differ depending on who you are. So they mash up all the information that they get from all the different forms, and it spits out and it helps them identify, and then it's automated. That's the word I was looking for, automated. So that a letter automatically spits out. I think it automatically spits out. So I don't work for them, but let's talk really quickly about the forms. We have a separate reporting seminar that goes in detail through all this, but we're just doing a super light touch so you understand what the forms do. Who has to create file and furnish forms, meaning filing with the IRS and furnishing them to individuals. First of all, it's the exchange/marketplace. Anybody who gets coverage on the exchange and or gets a subsidy, all of them, even if you don't, gets a 1095-A form. And those forms are also submitted to the IRS as well as the enrollee. Providers, meaning health insurance carriers that do fully insured plans and small employers who sponsor a self or level funded plan, they do the B forms. Those B forms have information, but not as detailed as the C forms. That information on the B forms only is showing who is enrolled. That's it, who's enrolled. And then large employers, they do the C forms, and the C forms are the most complex, and those are the ones that take the most time to create. But that gives all kinds of information. Basically, did you offer coverage? Was it basic, minimum essential coverage? Was it affordable? Was it minimum value? And who was enrolled? You're providing all of that information, as well as just information about you as an employer generally. Okay, again, here's another slide that goes over the same idea. Here is which employers must report. Again, all large employers, whether you offer coverage or not, must report. Some, but not all, small employers must report. Those are the ones who, if you're a small employer, and we'll talk about what that means, small, you sponsor an insured plan rather than self or level funded, you don't have to do the forms at all. But again, we have a toolkit for you to help understand whether you're a large employer or a small employer. That would be our step one. And we'll talk in more detail about those steps next week. The other thing I wanted to identify before we move on from the employer mandate is that there are penalties for failing to offer, right? Or failing to offer to 95% of your employees, and or what you offer isn't affordable or meet minimum value. But you also have possible penalties if you fail to file your 1094, 1095 forms, and that's a different set of penalties. So technically, if you fail to offer affordable minimum value coverage to at least 95% of your full-time employees, and you're large, and you fail to report your 1094, 1095 forms, you will get hit up with two separate penalties. So the reason you would get hit up with this, I have on the bottom here, 3, failing to file at all, filing incorrect or incomplete forms, or filing or furnishing forms late. So when we're talking about filing 1094, 1095 forms, you not only want to file them, but you want them to be correct. We had several years where it was a transitional rule where they were saying, hey, we understand everybody's learning. We're a lot more lenient on making mistakes. We'll let you fix things if you get dinged and explain. That transition rule has gone away. The IRS is a little bit behind. They're not behind in their mind, but they're not up to 2023 reporting. They're back in 2020, 2021. And so we haven't hit the penalties yet that don't have the transition rule. So we don't know exactly what it means when you can't correct. But right now you can make some corrections if you get hit. Or if you file or furnish late. So it's not only important to make sure you file, but file correct forms and file forms on time. Okay, and here's the penalty. I showed you the penalties on employer mandate. Here's the penalties for reporting, the up-to-date. As you know, everything gets indexed, and here's the how late you are depends on how the amount you have to pay. So if you're late and you get them inside of 30 days, you're going to pay a lot less than you are going to pay if you're really late. Okay, so we've gone through the exchange. We've talked about the employer mandate. And we're going to talk about the individual mandate just really quickly. And these three together, as you can see, kind of interact with each other because one feeds off the other. So you could go to the exchange to get coverage. There's the triggering of the penalties, and they interact with the employer mandate. The individual mandate used to interact more with these three, and it's changed since original, but it's still important for you to understand what's happening here. So here's the general original rule, even though it's changed a little bit. Individuals, some of you may remember, must obtain minimum essential coverage or at least basic coverage for themselves and their dependents, or pay an individual penalty or tax. And you can see now why maybe this all fits together, because they want individuals to get it, they want employers to offer it, and they want to help people who can't pay for it in the exchange, and it all kind of gets mashed together. So the tax for that, if you're an individual and you don't get coverage, is calculated, is paid annually, but it's calculated on an individual month-to-month basis, and it's reported on your individual tax forms. So I don't know if you remember, there were times when you may have had employees asking for your forms. Where's my 1095 form? Where's my 1095 B or C form? It's because it was showing on the taxes that they needed the information from there. But there were some exceptions. We won't go into that detail because we don't need to anymore, because there were changes to the individual mandate and another act that was passed in 2017 that changed the actual tax. We used to talk about the tax and what that would mean for individuals and how much extra they would need to pay, changed to 0. So the mandate, the individual mandate still exists on the book. It wasn't repealed. It's still there, but it has no teeth because the penalty is zero. And those changes were effective in 2019. No other provisions to these big parts were changed other than the individual mandate. So what's the effect of this and why, Susan, are you bringing this up? And why do I need to know this? Individuals no longer pay the penalty if they don't enroll in your coverage. So they may not be as motivated to participate in your plan. So that affects you as an employer for different reasons other than the rules. I mean, you talk about participation and that's an issue. Many people, even though this was went to zero, many people still want health coverage even without that requirement, right? So people are still wanting that. Large employers still need to offer coverage under employer mandate. So that didn't go away at all. There's still some confusion. Well, I thought that went away. It did for individuals, not for employers. It has not hurt or impacted the ACA as a whole to take this out. Some people looked at the three, the exchange, the individual mandate, and the employer mandate is a three-legged stool. And if you take one of those stools out, the individual mandate, that stool wouldn't be stable and it wouldn't work. But it has actually been okay and has still been a positive thing for a lot of people who weren't able to get coverage anyway. And in some industries, however, the participation may have gone down. And I don't know if you're in any of those industries, but last thing on US Supreme Court, just so you're aware, I don't know if you remember, but this issue was the individual mandate was brought up several times. It ended up reaching the Supreme Court a bunch of times. And whether, we won't go into details, but is it constitutional to have this individual mandate? And the Supreme Court said basically yes on both. So that wasn't changed at the Supreme Court level at all. Okay. Here's the other thing that I want you to be aware of, and a lot of employers are not. Even though the federal individual mandate went away in terms of penalty amount, so the individual mandate may exist in states where you have employees. In other words, if you have if you have employees in California, Massachusetts, New Jersey, Vermont, Rhode Island, and DC, those individuals do have an individual mandate, meaning the state requires them to get some sort of coverage. And you, as an employer, are required to do some reporting based on state laws. Now, we're not going to go into the details of what each state is requiring and what you need to do, but we do have that information. We have it in the form of a summary that has links and information for each of these states. So, and this is the name of the document that you want to ask for if this applies to you. It's the state-specific individual mandate rules and annual information reporting requirements. So make sure you're aware of that. Okay, so we have been through the three main parts that you hear about most with the ACA. We're going to talk just really briefly about some of the tools, and of course, we'll go into more detail about some of these tools that we have that you can use as clients to help you get into compliance. And then we're going to spend the rest of our time on the market reforms, or the other part of the ACA that doesn't get a lot of attention. It's the sister who's in the shadow of the popular, or the one that gets that hogs all the attention. Okay, so here's our tools. We have, I referred to them before, a GBS 4-step process specifically for the employer mandate. It's 1 through 4, steps 1 through 4, and it helps you walk slowly and very carefully through, not slowly, very carefully to make sure you are capturing the information that you need and understand how you need to comply. We've got calculators that are associated with that. We also do, and I think I already talked about this, an annual seminar on 1094, 1095 reporting. And we encourage you to take advantage of these steps very seriously so that you can make sure that you are, I lose sleep about you people. If you're not, I want you to not get dinged. And I'm sad when they send me a letter and say, oh, we got dinged, help us understand what this letter is. So I'd rather have you not have that letter. So here's a little bit more detail on the 4 steps. This is the only slide we have today. We'll go into detail next week. But step number 1 is determining your size, right? You need to know whether you're large or small. If you're small, You don't need to do the other steps, and you just will want to recalculate your size every year to make sure that you haven't exceeded that threshold and now you're exposed to penalties. Determine your compliance date. When you become large, when does this law apply to me? That's what we help you figure out and calculate. Step 3 is that important step that is done every year. These other steps aren't. This is the one that helps you calculate your affordability safe harbor. This is what you, in your head, you should be saying, step 3, have I done step 3? Every time you're working on renewal and before you at the beginning of your new plan year. And then step 4 is determine which employees are eligible and when. And this is going to help you create an actual written measurement method policy that helps you apply a particular situation to that policy and helps you actually identify a precise date that that person is eligible or not eligible. We do this reporting seminar, webinar, depending on whether you come live or not. The rule is that all large employers and some small employers must file and furnish the 1094, 1095 forms. And you'll be doing the C forms. And then some employers, but not all, need to do the B forms. If you are a small employer and you sponsor an insured plan, you don't need to worry about any reporting. But if you sponsor a self or level funded plan, you need to make sure you get those in. They're a lot simpler than the C forms, and you don't need to learn as much, but you still need to submit those. And this is just an outline of what is in that seminar. Just so you know, we do a background and overview on the rules and how to make sense of what's happening. But then the more important thing, I think, for practical purposes, is to dive into the line by line on the forms and to help you understand what each line means and how to make sure that that line is accurate. Even if you're using a vendor, even if you're using Employee Navigator through us and using the self-service tool, which is through us, through Employee Navigator, again, that's self-service. So you want to make sure you know how to review the forms and make sure that they're accurate. Just because whether you use that or some other method, whether you're going through payroll or even have another vendor who's kind of giving you a white glove service, you're ultimately responsible to make sure that those are correct. So how do you know how to check those forms unless you know how to understand the rules? So that's the point of this seminar, and we hope that you'll take advantage of that. So, okay. Any questions before we move on to the last section on market reform? So you understand, yes. Okay, the question is, when do we provide the 1094, 1095 seminar on reporting? Typically, we will do that. We used to do it in fall, like October, but we've realized that you guys, many of you are caught up in fourth quarter issues, and so we've moved it to December or January. So it depends, basically, is when it is, but we'll get notification, and if you let your GBS team know that you're interested in going. We always send out marketing emails that announce it, so you don't need to hear it from your GBS team, but you can make a point of saying, hey, will you make sure you let me know when that is? So, and we record that as well. But again, I love seeing your faces and I want to hear your questions as you're thinking about. So I'd love to have you come here too as well. Okay, so here's our visual that I personally think is really helpful to help you understand the 4 main parts. We talked about the exchange, the employer mandate, and the individual mandate, and how they sort of dovetail together. Sometimes I refer to them as the big 3, and then we had the leftover, which is not leftovers. These are really, really important reforms, and the ACA is about far more than just the employer mandate and the forms. There's many, many provisions that that affect group health plans and are meant to make improvements for individuals and consumers. So let's jump in. I'm going to spend, here's the list of all of them. I'm just going to have one slide on each of these. So we're super high level. I just want to make sure you just have an idea. And if we run out of time, you have the slides. But I have the side on the left in darker black font than I do on the right, because the ones on the left, you may have to engage in some way. And the provisions on the right sometimes you may not have even been aware of those because your TPA or your insurance carrier is already kind of included those in, and it's kind of been automated now, and you may not even be aware. So, but all important to know. So we're going to focus on these in the black, and then if we have time to go into the others, it's really really helpful, I think. So the first thing are notices. ACA has added, you have your annual notices you have through ERISA and when you have open enrollment. There are some notices that were added through the ACA, and one of them is the exchange notice. Who's aware of the exchange notice? I shouldn't make people, never mind. Okay. I don't want to embarrass anybody. But this notice is a notice that explains, just basically says the marketplace exchange exists, and we want you to be aware of that, and we want you to be aware that that's an option. And COBRA notices have also been adjusted, the templates, so that COBRA notices even say, hey, you don't necessarily need to go on COBRA. You have another option. You can go to the exchange instead of going on COBRA. But these notices are created. There's a template that's created by the DOL. All employers of all sizes, whether you're large or small, and almost all of these market reforms apply to employers of every size. It does not matter what your size is. So a lot of people think, oh, I'm a small employer, so I don't need to worry about the ACA. Well, you may not need to worry about the employer mandate, but you have a lot of other obligations and responsibilities. So you need to make sure that you're providing this particular notice to newly hired employees within 14 days of hire. Everyone, whether they're eligible or not, they should be receiving this notice. Grandfathered plan notice. I hesitate to even include this in here because most plans are not grandfathered anymore. There's been enough time, so I'm not going to spend any time really talking about it. But if you happen to have a grandfathered plan notice, you will be aware, and you need to be reminded that there is a plan notice that you are a grandfathered plan that you need to provide to your employees. There are fees that come with the ACA. Some of those are now either sunset or were taken away, but there's one that still exists, and one that some of you are probably very aware of right now because the deadline was yesterday, right? But it's the PCORI fee. And this is a fee that helps fund the Patient-Centered Outcomes Research Institute, which was created by the ACA, and basically was an institute that wanted to create science and research that was objective. A lot of the science and research that is done is not necessarily objective because they have a vested interest in the outcome, and this is intended to create more objective information. And this is an area that there's not a lot of debate across the aisles politically about whether this should exist. So it will continue, I think, through the 2029. Originally, it was supposed to end in 2019, but it's positive enough that Congress agreed to extend that through 2029. The fee amount started at $1 per covered life and is indexed every year. And you know that amount was a little bit different. It was in the threes this year, depending on when your plan year ended. It was due yesterday. You use a specific form that already exists, Form 720, and you need to make sure that when you're counting number of covered lives, that's the amount you've got to figure out. In that calculation, you need to make sure you're using a method of counting these covered lives in a way according to the rules. So if you don't know if you counted right, make sure you get our summary that explains the different options for counting. Here's a list of expired or repealed fees. We have 3. You don't need to worry about these anymore. The 90-day waiting period is a big one that we still have some confusion about. But all group health plans, no matter what size you are, must have a waiting period that does not exceed, for eligible employees, that does not exceed 90 days, meaning an employee, if they're eligible, can't wait more than typically first of the month following 2 months, because if you go beyond that, it's going to go beyond the 90 days if you do a 3-month or whatever. So here's the frequently asked question. I don't have any frequently asked question attached to any of the other ones because for time, but I added this because it's a big one. Can we have a different waiting period for different categories of employees? The short answer is no, you are not compliant if you have a waiting period that is shorter for your execs and longer for your other employees. So make sure that you understand that. There's confusion about that because the ACA doesn't prohibit that. The ACA doesn't even address that. You're not in violation of the ACA. If you do that, you're not in violation of HIPAA non-discrimination rules. That's the rule that says, hey, you can classify your employees and treat them differently based on a reasonable business activity or whatever. So, and in that case, you can classify them differently. If they're paid hourly, they could have be treated differently than paid by salary, but not when it comes to the the waiting period. That waiting period under Internal Revenue Code states that you need to make sure you're going to fail non-discrimination testing if you don't. Okay, summary of benefits and coverage, the SBC. This is another notice that came about because of the ACA and that is given out at open enrollment. Employers of all sizes, large or small, must provide this 4-page standardized form for all of your offered plans. And the reason for this form is an intent to try and make shopping easier, meaning your food ingredients and nutrition labels. That is the same template that all food in the US has to follow, right? The idea here is the same. It's easier to compare cereals if you look at the 2 boxes and the nutrition labels. And it's easier to compare plans if you have the 2 SBCs and the information is laid out exactly the same way. So it's really helpful to have those SBCs when at open enrollment, when your employees are trying to make decisions so that they can compare side by side. Form W-2 reporting, that is a requirement that's only for those who had, in the prior year issued more than 250 W-2 forms. That's how they define large. So in other words, under the ACA, there's different definitions of a large employer. Under employer mandate, we talked about this, it's 50 or more full-time employees plus full-time employee equivalents. But under Form W-2 reporting, it's 250 W-2 forms filed in the prior tax year. So if you are larger than this and you are not doing this, make sure you start adding this to your W-2 form. You're going to populate a code in box 12 that lists the total value of the coverage that you're offering. And that total value is the employer cost, and employee cost, and we've got a big summary that gives you some more details. But only large employers must comply. Technically in the law, all employers are supposed to be doing this, but this is one of those provisions that is on hold for anybody who is under 250. So one day they may say, okay, all employers need to do this, but for now it's just the larger ones. Medical loss ratio rebates. Has anyone received in the past an MLR rebate? Or do you even know what we're talking about? Yes? Okay. The MLR is an acronym for medical loss ratio. It is a rebate of the medical loss ratio means it is a rebate of the premium payments that were received by carrier that they are now no longer allowed to keep. And here's how it works. A carrier must spend, according to the ACA, a minimum % of the monthly premium that it receives from you. So you say, for example, you give $1 to your carrier, and that carrier is supposed to spend a certain amount on you guys and your plan versus their own internal administrative bonuses, whatever. So they need to spend at least, if you have a small plan, at least 80% of that dollar or 80 cents of that dollar on you and your plan, or 85 cents on you and your plan. And if they exceed that, or if they don't meet that, and then they have to refund that money to you to use appropriately. So the rebate is based on the average MLR within a risk pool. So they may have exceeded it in you individually, but they average it. Like if you're in a small group, they're going to average it in that state. Or if you're in your large group, they're going to average that in your state. And if on average that they didn't meet that, they didn't spend that much on your plan, or on average on those plans, they have to rebate everybody in that category. If you receive that money, that money is not necessarily yours. It may belong to your employees or participants as well. So it's really important that if you receive that money, you distribute that money appropriately and you distribute it within the time allowed. If you distribute it appropriately within 90 days, you don't have to take these other steps on getting a trust and so and so. But if you don't, then you fall into all kinds of other issues. So the bottom line here is if you get an MLR rebate, just make sure you know what you're doing with that. And if you don't, we've got a summary for that and help for that as well. Wellness incentives. How many of you have a wellness plan? Not very many of you. Okay. Oh, a few of you. The ACA allows you to, generally, you can't treat people differently as to a health cause under HIPAA non-discrimination rules based on a health factor. You can't treat anybody differently. But there is an exception to that for wellness programs. And the ACA created an incentive that is allowed to reduce or stop tobacco use. And so if you have one of those plans, you can create an incentive to help people or reduce that use. And you want to make sure that you're navigating that correctly. And we have a GBS wellness team who can help you navigate that if you like. So make sure that the whole point here is we won't go into the details, just make sure that you are using that and applying that correctly and within thresholds. Rescissions. A rescission is a retroactive cancellation of coverage that is not allowed according to the ACA. You are prohibited from rescinding coverage for a participant unless, two exceptions, the reason for rescission is directly related to failure to timely pay premiums or a participant commits fraud or intentional misrepresentation of a basic fact. So there's that. Any rescission is retroactive is not allowed, but of course, prospective cancellation is permitted for a variety of reasons according to different compliance rules. This is a big one. Prior to ACA, for those of you who haven't been around as long as I have been, you were not allowed to stay on your parents' plan past the age of 18. I remember being kicked off my parents' plan at the age of 18 and trying to find an individual plan. And that was really awful because nothing was affordable. But now, gratefully, and I'm grateful that I could keep my kids on until they were age 26. Until they are. And so, yes, you need to make sure you as an employer help employees understand that their kids can be on your plan up until that age. And a child is defined as, because I get this question a lot, actually biological daughters or sons, but also stepchilds, adopted child, children, and foster children. Obviously, you have to have paperwork to prove that, but that's that. Pre-existing condition exclusions. This is another big one besides the age 26. That one and this one are a huge one that everybody seems to agree with across the aisle. A pre-existing condition is no longer, or exclusions are no longer allowed. A pre-existing condition exclusion is that is a tongue twister. I don't know why. Is any limitation, exclusion, or denial of benefits based on a condition present, a health condition present before the effective date of coverage. So some people who have some serious health or some health issues that cost more, insurance plans, I don't know if you remember, those of you who are younger don't remember this, but they couldn't even get coverage for a while. They would have to wait. And now the ACA is saying, listen, everybody needs to be able to get on coverage, even your sick people. So you can't exclude them based on that. So everybody has liked that one, and the ACA has been great for that. There's also some external and internal claims review requirements that we won't go into, but make sure you understand that there are specific rules through which your administrator, whether it's a TPA or if you're self-funded, or your carrier, if you have a fully insured plan, is administering their claims correctly according to the rules. Modified community rating was an attempt to, and I think successful actually, to help individuals in small group policies. Because small groups typically were having a higher cost. They couldn't get the benefit of a larger pool. And so they were paying costs higher. And so this rule says that carriers may not set rates based on the health of individual or group. and may so there's no collection of health history on small plans, and this is why. But they can collect three things. They can collect age information. They can collect geographic information, tier, and also tobacco use. Those factors are allowed on small groups, but other than that, not allowed. And so that is an attempt to help small groups have a more reasonable costs from carriers. Essential health benefits also is part of a way to help small group market. And all plans now in the small group market must provide at least 10 basic essential health benefits. Large plans typically do this for a variety of reasons. They can afford that more, but small plans just were really skinny and really not very helpful and were expensive. But those 10 items are here and they must be included. So you may not be aware of this in your small group, but this now is a requirement. So all these basics have to be there, and they weren't in the past for small group. Annual and lifetime limits. How we go? Okay, I said I could all do this one. Cost sharing limits. You know what? We'll do annual and lifetime limits and then stop. And then you can see we have just a few more preventive services for women. You know what? I'm going to do this one instead. This one is something that has been something that everybody has really liked, which is a group health plan must pay for specific preventive services. So if you go in for a well visit or immunizations, for example, or I need contraception or whatever, all those things are supposed to be paid for without any out of pocket, are covered, sorry, without any out of pocket. So you have a list here too. A lot of prevention screenings, mammograms, vaccines, and so on. So, and counseling. So, and then there's a specific list of preventive services for women. And there has been a lot of litigation around contraceptives. I don't know if you've paid attention to that, but we will just keep going through here. There's just a few more and end on questions so that we have, 2 more minutes. And if anybody has questions, now's the time. That's great. Thank you. I will go into more detail on that next week, but I think that's very valid. The question is, what do you mean by 95%? Offering to 95% of your full-time employees, and how does that impact whether you get penalized or not? The 95% is an attempt of the regulators to give you a margin of error. You've got a 5% margin of error, and you can use up that margin of error of 5% intentionally or unintentionally. So you could decide, hey, and it's all percentage, right? So if you are an employer of 10 people, 10 full-time people, and you have a 5% margin, you could not intentionally not offer. No, you can't have that 10%. You'd exceed it. 100. Let's say you have 100 employees. Yes. You could intentionally offer not to one person, and still not get, even if they went to the exchange and not get triggered. You would run into other issues like, well, in terms of consistency and offering, depending on your plan documents, but under this rule, you wouldn't get dinged. So does that answer your question, or do I need to go into more detail? Okay. That's a great question. The question is, I use the word offer. You need to offer coverage. You need to define offer. And how do we prove that we offered? There's an offer is they understand that they are eligible for coverage. And there's nothing in the regulation, and they are actually given the opportunity to enroll. There's nothing in the regulations that define offer or say how you can prove that you have offered. But a lot of employers have platforms that you have proof because they have to affirmatively say yes or no. Or a lot of employers have employees sign a form that says, I understand that I was offered coverage. I understand I'm opting out. Sign. So it varies depending on what employers wish to do. But to be the most careful, if I'm an employer, I would probably create a form if I didn't have a really robust platform that's doing that making them opt out online. So you're welcome. Really good questions. Anybody else? And any question, by the way, is a good question. So there is no stupid question. You don't need to be embarrassed. I'm a safe place. You can ask whatever you want to ask, and I'm happy to help. So anyway, thanks for attending.